Hi, I'm Jenny Brown, and a very warm welcome to our weekly buy-to-let market update. Today I'm in the office, so behind me you'll see people. Sorry if you see people moving around doing officey things. Hope it's not too distracting for you. Looking at what we have seen this week from lender changes, we've seen a bit of repricing, a bit of jostling going on. So first of all, Virgin have repriced their products downwards. That actually went up only a couple of weeks ago. So again, it's what we're seeing here is just a lender who's kind of repricing up and down in accordance with their business volumes, just trying to manage workflow and service standards. And there's a real theme throughout with this. Platform home loans have temporarily removed all of their buy-to-let products from the market just while they play catch up with the applications that they've had in. It's expected to be a temporary pause on applications rather than a total withdrawal from the market. We've also seen Skipton increase their rates by a fairly small margin, again, just trying to push their pricing up a bit to stave off business volumes or keep business volumes down to a manageable level. And lastly, we've seen Clydesdale withdraw some of their products. Again, they're citing the reasons to help manage their pipeline and maintain service. So a bit of moving around on pricing. And again, it's just really more repetition in terms of the themes that we've talked about in previous weeks with regards to lenders looking to stay on top of service standards and not totally falling over where they're getting absolutely swamped with applications. Now, additionally, in the last week, we have seen Fleet Mortgages reprice their products, and they've also introduced a lifetime tracker, which is tracking Bank of England base rate. Now, the thing that I particularly like about this product is it comes with no early repayment charges at any time, which is really good. But likewise, the rate is tracking base rate for the term of the mortgage. It's not for 2 or 3 years, it's for the whole 25 years or however long your mortgage term's for. Now, Fleet are an interesting lender. They are very good at lending to individuals and limited companies. They're very happy with landlords with large portfolios, no problem for them. They're also able to lend on standard properties, 6-bedroom HMOs, and also multi-units with up to 10 self-contained units as well. So very broad criteria. And we also find them very good to deal with as well. So great news to see those guys bringing out a product which actually is fairly unique in the market, particularly in that space at the moment. The other bit of change we've seen in the last week is that LendInvest have refreshed some of their criteria. So they're now lending up to 80% loan to value for loans of up to £500,000. They're now increasing their max loan size to £1.5 million for standard properties. And they're accepting multi-unit freehold blocks up to £3 million and 75% loan to value. So again, some positive changes from LendInvest, looking to really increase their reach into the more specialist end of the market. The Bank of England have also released some data this last week, which tells us that mortgage approvals for house purchases increased to 84,700, the highest since October 2007, according to the latest data released by them. Now, what they went on to say is that net mortgage borrowing was £3.1 billion in August, which stayed consistent with the total recorded in July of £2.9 billion, whilst effective mortgage interest rates were broadly unchanged. Now, the Bank of England went on to suggest that these latest figures signal signs of recovery in August, despite mortgage borrowing being troughed at £0.5 billion in April, and still being slightly below the average of £4.2 billion in the 6 months to February 2020. And what this is all really doing is signalling and reinforcing the data that's being provided with regards to the housing market and the increased level in buyer activity, which we've obviously been reporting in the last few weeks. Dovetailing nicely on from that, moving on to some housing market data for you now. And there's quite a bit of data that's been released in the last week. So first of all, Zoopla has released its latest house price index, and what it says is that the market continues its recovery following lockdown. New sales agreed have outperformed the same period in 2019 by 3%. Now, in addition to that, a price comparison site, Really Moving, have been reported to say that house prices are on course to rise by 14% between August and November. They're saying that average house prices are on course to increase by 14% in the 3 months between August and November 2020 from £296,485 to £336,946. And they allocate this really down to significant pent-up demand in the market and an urgency to complete to make use of the stamp duty holiday. So not exactly anything we aren't aware of or groundbreaking news, but really just more data that underpins the market, reports that the housing market is very, very busy at the moment. So this week, we're going to start our sessions on limited company borrowing. And we're going to break this down over a period of weeks because it's fairly involved in terms of the breadth of the points that we can cover off. And this is meant to be a quick weekly update. So first of all, to really just cover off with limited company lending and that as a structure, why people actually use it. And I think it's fair to say that for the vast majority of people, using a limited company is born out of a desire to be efficient with our taxes. So before Section 24 was announced and the way that rental income was taxed when we owned properties personally was done in the old-fashioned way, limited company lending was fairly it's fairly rare, actually. I mean, we've always done it here at Mortgages for Business, and we did do some limited company lending, but nothing like the volumes that we see these days. So largely the reason people use limited companies is born out of a desire to be efficient with their taxes. Now, one of the questions we'll get asked very, very often is, actually, does this work out best for me? Should I be using a limited company for my property investing? And I'm afraid the very short answer to that is that we are not tax advisors at Mortgages for Business. We're very, very good at mortgages, but we can't offer tax advice, I'm afraid. So what we would tend to do for people who are asking us that question is that we will put together two proposals for them. One if they were to finance the property in their personal name, and one if they were to finance the property through a limited company. And then what we encourage them to do is go and speak to a tax advisor who will be able to line up the financing costs against the tax position they would be in for either option, and then agree the course of action between themselves rather than us making that decision for our clients. There are other reasons why people would look to use a limited company structure. These can be more for legacy planning, i.e. Leaving things to children, for example. It also can be linked to when we have someone who has a company, which is kind of their day-to-day business, a trading company, and they have money in this company that they want to invest in property. And what they don't want to do is take the money out of the company and pay tax on it. They want to use that money as a deposit. So some people may set up a new limited company to invest in because you can move the money from one company to another in a fairly tax-efficient way. So that's kind of very broadly why you would consider using a company in the first place. Now, in terms of what is an SPV, and this is one of the biggest questions we also get asked. So an SPV is, in the mortgage world, simply a limited company. It's a normal limited company. There is nothing fancy about it. But this company, its only activity is renting out property. In the mortgage world, when you have a company which does anything other than or as well as letting out property, we class it as a trading company. So when we're speaking to our lenders, the majority of lenders who lend on limited company lending will only lend to SPVs. Most lenders aren't in the market for trading companies. And actually, if you have the time to watch our MFB live event, which we did earlier on today, we had a really great conversation with a couple of chaps who really explained why lenders prefer not lending to trading companies. So it might be worth you having a watch of that. But yeah, so generally speaking, lenders want to lend to SPVs. And SPV is just a straightforward company. You can set them up via Companies House yourself. It's very easy to do. It doesn't cost a huge amount of money. I think when I did mine about 5 years ago, I think it was around £20. It's very simple. But the key point is that the SPV, it really denotes or refers to the activities of the company. And in this situation, an SPV would be a company which sole activity is letting out of property. Now, one of the things people will mention that you may hear talked about is an SIC code, a SIC code, a standard industry classification code. Now, when you set up a limited company, you don't have to do this the second you set it up. When you do your first return with Companies House, you will be asked to tell Companies House what your company actually does. And what your this does is expressed as a code, a series of numbers. So you will find that a dentist or a dental practitioner would have a particular code, or mortgage brokerage would have a particular code, and letting of property also has a code. So it's really important that when you do allocate this code to your company, if you are using SPV, you register the right code that's appropriate to letting of property. And the reason for this is that when a lender receives an application from your limited company, if they go onto Companies House to do a search and they look down and they see, oh, hi, this is Jenny Brown Limited. Oh, its activity is actually, window installation. Immediately, my company isn't an SPV in this lender's eyes. So it's quite an important thing. So just for your own reference, the codes lenders really like to see are 68100 and 68209. Now, in terms of setting up a limited company, as I've just referred to, it honestly is quite straightforward in terms of if this is a very simple structure. So if it's just me setting up a company, or me and my partner or husband setting up a company, or me and a business partner, and we're going to own the company 50-50, it really is quite straightforward to do. So you can go onto Companies House and do this. Now, where it can get complicated is when you've got a more involved structure. So if you've got, for example, a company owned by a company owned by people, or you've got lots of different shareholders, if there's any kind of trust arrangements in the background, this can become more complex. So I don't want to kind of underplay how this can be quite involved. But actually, for most of the cases that we see, most of our clients, it really is quite a flat structure. Now, when you are setting up your company, this is the thing that is really important to understand, is the implications of who you choose to be your directors and shareholders. So, when you apply for a buy-to-let mortgage, a lender is obviously lending to the company, but ultimately what they're going to want is unsupported personal guarantees from certain people within the business. And these are the people that the lender is really saying, well, if things don't work out, we have to repossess the property and we're owed money at the very end. Who do we come after? Who's ultimately responsible for making sure that we get our money back? And so these are the people that the lender underwrites. Now, generally speaking, with limited companies, lenders will want to take personal guarantees from all of the company directors and all of the shareholders, or shareholders with a share of 20% or more. And it does vary from lender to lender. So what we have seen in the past is applicants where they have decided to set up a company, husband and wife, just to be very stereotypical, are the directors. They've got a shareholding of, say, 30% apiece, and the last 40% is given to their children. Now, unfortunately, because children cannot legally contract, they cannot offer personal guarantees, and that precludes them from taking mortgages with certain lenders. And that's just one example of how this can kind of impact things. So before you do set up your company, it's really important to first of all get advice on the most appropriate structure for your kind of requirements and your tax planning and all the rest of it. But also it's just worth referencing that with us to make sure that the structure that you ultimately decide on is going to mean that you can still obtain a mortgage going forward, so you're not going to have any problems. Now, what I would say is that if you have got a company and the structure or the shareholding is not quite as straightforward, so for example, we have children having large percentage ownerships, if one of the shareholders is, for example, overseas, don't worry, there is always a way to kind of work with this, but it just means making sure that we're approaching the right kind of lender for your requirements. So once you've set up your company, the very good news is that you can essentially apply to take a mortgage out through it the next day. And normally the companies will register, incorporate overnight. So if you did a application to set up a company today, you could apply for a mortgage through it tomorrow. So it's actually very, very quick. So there you go. That's kind of the first part of the limited company masterclass I'm going to be taking you through, which I hope helps. Next week, what I'm aiming to cover off is applying for mortgages, what the mortgages actually look like, what the applications are, and what you can expect. But hopefully, that's a helpful starting point for you. So that's me done for today. Thank you, as always, for joining me. Earlier on in the day, I did mention earlier, we hosted MFB Live, which is a free landlord event. And I have to say, that actually the conversations that took place with our guests were really fantastic. There was some really good content that came out of it, and actually even I learned a thing or two. So if you do have some time, we've recorded the event. You can watch it on our YouTube channel now. So if you weren't able to attend, don't worry. Please do go and have a watch, because it's really fascinating stuff, and I think you'll find it really useful. So until next week, look after yourselves. And as always, if you do have any questions, you know where we are, 0345 345 6788 or mortgagesforbusiness.co.uk. Look after yourselves, and I will see you next week.